Revenue is pretty lengthy. I won't lie. Revenue is pretty lengthy. Okay. So for this revenue, I'm going to use the faucet paper. Okay. Because I was longing for such an integrated question that is revenue, lessor, and investment property. So when they're asking you on Tuesday, okay, I think it's going to be something similar, but similarity in the form that the topics will be there and the principles that she or he has shared with you, all right, when you attended this class, it's the same things that will be asking you on. So please don't black out on the day and say, I don't know this. You know it, just that you're now panicking because it's a test. Right, so let's read. Right, Veranda is a large farming enterprise located in Mokopane, South Africa. Veranda listed is the largest producer of tomatoes, beetroot, and cabbages in the Southern African region. Wow. The company is listed on the JSE and has a 31 December year end. All right. Then I want to go to and read the required. Please disclose the following notes in the annual financial statements of Veranda Limited for the year ended 31 December 2022. Right, deferred tax note relating to revenue transactions only. Investment property notes. Profit before tax note. So if I were you, I would draw out these notes. Let's start with the revenue. It says, during December promotional campaign, during December 2022, Veranda ran a promotional campaign that offered its wholesale customers a 15% discount on further purchases. So 15% discount on further purchases of vegetables of what? In January. The 15% discount is only available to customers who make vegetable purchase of more than 2,500,000 during December 2022. Right, on 31 December 2022, at the end of the current year, right, 4 wholesalers wholesaler customers were eligible for 15% discount voucher. Right. Veranda estimated that the 4 customers will redeem the discount voucher in full. So you estimate there's an expectation. Okay. So remember, as I said, revenue, IFRS 15 is a broad topic. You can't really cover it within 1 or 2 sessions because there's so many things that involves sales to customers. All right. But based on this one, this is like your loyalty program. Okay, this is like your loyalty program. So if I may explain this in simplicity, right? Remember, whenever you are offering something to someone, or if ever you are selling something to someone, and a customer comes through to come and what and buy from you, right? You make promises. You make promises to the customer. All right. So according to the business, right, you're supposed to what? Fulfill the what? The promise. Okay. And then if I may explain it this way, right, as you fulfill the promise, you what? Recognize revenue. Okay. As you fulfill the promise, you recognize revenue. All right. So I like to use this example. Okay. You want to go away. You want to go to Durban in December. Okay. You've managed to get a bonus or you've managed to get a lump sum somehow. So you want to go to Durban in December. And then you're going to go to what? You're going to go to what do you call this? Is it Airlink? Right. All right. There is your plane. So you've booked a ticket for how much? 5,000 rands. You've paid. But your trip is when? In December. I'm going to say Devon. It's in December. Right? So you have paid in advance. So that means SAA, if it's still alive, right? SAA, right, will hold this money, right? They cannot account for it in its books, right, under the profit or loss as revenue and say 5,000. No. Why? Because they need to what?
Fulfill your promise.
The promise. Only once you are happy can they say, oh, this is what you call revenue. You can recognize revenue. All right. Because now is what they call the prudence concept. All right. They do not want you to overstate or to overvalue the what? Your profits. Okay. So that's why they're saying, as you fulfill, that means the customer is happy. Then we don't expect you to return the money to the customer. So you can recognize it. But before that, you hold it somewhere, right? You have the money, it's in the bank, but it's not recognized as what? As revenue. So you hold it as what? As a liability. Rebecca is reading. As a liability. It's a contract liability. So once you bought the plane in December, then SAA can say, oh, okay, let's move it from liability to what? To there. Why are they holding it under liability? Because remember, a liability is a debt. So a debt is you're saying you are owing someone something. So as long as the company is not fulfilled its promise towards you, its promise is to fly you to Durban. So as long as they have not yet fulfilled that promise, they have to hold it somewhere under liability. Okay. So same thing applies to this. Okay. Same thing applies to this one. This company is saying, guys, if in December, the current year end, if you are to spend 250 million in buying our products, we are going to give you a 15% if you are going to spend at least 1,300,000 in January. All right. So that means now, if you spend 250 million now, that means you have qualified for the what? For the promotion. Okay, for the promotion. Yes. Remember, I think not ShopRite. Spar is running a promotion now. The Hyundai promotion. Have you seen it?
No.
No.
There's a Hyundai, right? That someone is going to win if you're using their reward cards. And then I don't know if you're buying. I think there's a certain there's a certain limit or something that you have to. So okay, there's something that you have to fulfill to qualify to enter that competition. So what I'm explaining is same thing applies here. For you to at least qualify for the 15 discount is you need to spend this much now. And then in January, if you spend 1,300,000, right, you get a discount of 15%. So meaning to say that initially in January, when you spend this, what you're going to pay is not 1,300,000. It's going to be what? 85% of that. How much you get? Let's do together.
Yeah.
So you're spending how much?
1,105,000.
Yes.
Mm.
That's what they're saying. But in order for you to qualify for that, you need to spend now 2,500,000. Then in January, when you spend the minimum of 1.3, right, we'll remove 15% of that amount. So you pay less. And that is their condition. Okay. So what happens is, therefore, what does this mean? Same situation with the plane. You remember we spoke about the 5 million. So here we're going to speak about the what? The 2,500,000. That means in this 2,500,000, there's two promises. All right? There's two promises. The first one is that we're going to what? The first one is that we are going to what? We'll give you the what? The vegetables. Vegetables. Yeah? That you're buying now. And then the second promise is the what? Discount.
The discount.
In the future. So meaning to say that this company cannot recognize to in full, right? They cannot recognize 2,500,000 in full now. Yes, it will go into their account because you've bought. But according to accounting principle, within that 2,500,000, there are two promises. One is for the vegetable, the other is for the discount. So they cannot recognize the full 2,500,000 in full in December. That means, in other words, there is a portion that is a liability, which is the discount. You owe them because you have promised. So there's an example that was lingering in my mind. It's like a child. When you say to a child, if you eat this pap, I'll give you sweets afterwards. You understand?
Mm.
So in other words, when he's eating the pap, he's thinking of the sweets. So that promise, right? The child will never be happy until you give the sweets after he or she finishes the pap. All right. So you need to fulfill the promise in order for the child to be happy. So same thing with the custom, right? Because you've made two promises within this amount. That means you need to then allocate or cut this money and locate and say, within this 2.5, how much is the portion that is to be allocated to the vegetables? How much of this portion has to be allocated to the what? To the future discount, which I will recognize when I fulfill the promise. I don't know, does it make sense?
Mm.
It's like I'm preaching. Okay, I think I need water. All right, so that's what you get there. So let's try and then calculate and give the examiner what he or she wants. All right, so there is what they call, where should I write this? I need space. Right, there's what they call transaction price. Right, so transaction price is simple what the entity expects to receive. Right? If you go through the revenue videos that I did, you get all those definitions from the standard because I teach you in the standard, but because of time, I can't be referencing. I thought I would, but I see that we don't have any time and people will be tired before we finish. So it's simple the amount that the company expects. So in this scenario, how much does the company expect? The company expects how much? right? Times
2.5.
what? Times
4.
4, ne? Which is how much in total?
10 million.
Yeah, exactly. Right. So already the company received this amount in full in December. So now we need to cut it, or let me say allocate this 10 million, because within it is for the vegetables. The vegetables, the customers have received them, they are happy. But within this 10 million, there's a portion of a liability that we need to calculate and allocate as a liability. That's all we're trying to do. So you need to what? Use what they call the standalone what? You need to determine the standalone selling price. You use the standalone selling price to allocate. So you come and say standalone selling price. Right. For those that do not know, the standalone selling price, this is the price that you would normally sell, right? The promise on its own without any conditions. It's the price that you would normally sell that product on its own. That's why it's called the standalone selling price. On its own, how much is this product you're selling on its own? Okay, so standalone selling price, let's go. So for the vegetables, we all know that is the how much? Yes. Right? That's their price. You understand? Let's just use for 1%. That's their price. And then now for the discount. How do you get the discount value? You come and take that 1,300,000, right? Because we're trying to get the value of the discount. So the discount is based on 1.3, as the question said. So you come and say this times 15%, how much you get?
195,000.
Yes. What are we doing? We're just getting the value. The questions will differ because we want the value of that discount, right? Because that represents the what? The promise. So in total, you then add everything together. How much you get?
It's 2,695,000.
All right. So once you've got the total, right, you come and do the fun part. You come and allocate. You come and all right. So you can only allocate if you can get the standalone selling price. So here what we are saying is that the discount, its value is that much. So you add everything. This only helps you to what? To allocate. I know in mathematics you did what they call simple proportion. That's what we're doing here. So now you can allocate. You come and say 195 over the total, multiplied by the transaction price on its own without the 4, right? If you want, you can combine, it's up to you. How much do I get here? Someone calculate that value. Someone calculate the other one.
188.91.
How much?
It's 180,891.
600.
180,891.
Here.
It's 2,319,109.
So you see, we are just trying to split this amount. Now you know, oh, also, okay, this is the transaction price that the company expects. But even though this amount can be banked, they cannot recognize everything as revenue. So their revenue portion, right, equivalent to this amount here will be what? that portion. Then the other portion of 181 will be what? A liability. So, okay, for the fun of it, I just like to always generalize revenue, just in case on Tuesday they actually twist and say generalize that. And you're like, but how do I do it? All right. This is just an icing on the cake. All right. So you'll come and say 31 December, write the date. Okay. All right. How do you generalize? Remember, you received the money. So your bank is what? It's full. Okay. Your bank is full. All right. How much did you receive? Remember, you received, I'll just write it here. Times what? Which is how much? 10 million. Okay. So don't let this confuse you. You received it, yes. But now in terms of measurement of revenue, one that will go to the profit and loss, right? The P&L portion, all right? Will be that 2, 3, what?
1,
Multiply by what? By 4. How much you get?
9276
9276.
438.
8. Right. Then you credit. Liability has a credit balance. You come and say what? Contract? No, you said. Let's say receipt in advance. Ne? Yeah, you can call it interest receipt in advance. Income, sorry. Received in advance. Right, it's an SFP. It's a liability. How much? You multiply that one, or just say this minus that. 10 million minus 9,276,480 and 38. How much?
It's 723,564.
Okay, that's how you do it, people. That's the channel. If you're asked to channelize that, that's how you do it. But they did not ask for the channel here. They asked for the deferred tax. Right. So what is this? You can come and say income received in advance. Okay. So tax portion, what do we do there? Revenue recognizes that SARS will, that's what SARS will tax us more now. And then Tina, our income tax is lower. Then we have deferred tax asset. Yes. So second channel, right? You come and say deferred tax asset, SFP, then income tax expense, P&L. Right, what do? You take that figure, multiplied by what? 27. How much you get?
%27.
Yes, that's the new rate.
19536.
That is the new rate, people. Yeah, don't be confused. That's the new rate. You make that mistake, you're gone. Unless they tell you specific. If they are quiet, it's 27.
Yeah, it says 28.
Yeah, it's 28, Amos,
Where?
on the paper.
Okay, we'll use 28 then. All right, I'm used to 27. Because it's the new thing. But don't worry, don't stress to depend on the rate. It's not a train smash. But I'm just what? Warning you. All right? Don't stick to 28. Read carefully what it says. Right. And we are now beyond 1 April. Is it 30 April? No. Is it after 31st of March? 2023. Yes, 27%. So I wonder why they're using this one. That multiplied with how much you get there?
202,598.
202,598.
598.
Right. So remember, I'm not teaching you to cram the answer. I'm teaching you to cram the what? Exactly. So this should not affect you or make you worried. No.
Yeah, it is 28 because the year end is December 2022.
Yeah, that's why. But on Monday, if they say 2023, June or something, don't stick to that one. All right, blah, 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 blah. I'm not there. Okay, so this is an asset. Right. How do I know that it's an asset? It's too much. I thought this thing would be short, but there's so much to explain. Right. So when you get an income received in advance, right. So this is carrying amount, tax base, tempo, difference, deferred tax. Right. So they're saying it's 28. Né? Right. Thank you, Zandi. Right. So a carrying amount, we are saying what is the balance based on accounting books. All right. So based on accounting books, the balance is how much? Is this amount? 723,564. 700 and 464. Right. So that is the balance according to accounting. But it's a liability, remember? That's why it will be in brackets. Right? Because in the books of accounting, it's a liability because we have got someone's money, but we have not delivered on the promise. So it's a liability. So it's in brackets. Then let's just go and read. I have no choice but to make you go and read the standard. According to IS 12. Right, it's opened already. Right, it is paragraph 8. It says the tax base of a liability is the carrying amount. Is its carrying amount less any amount that will be what deductible for tax purposes in respect of the liability in future periods. Right, next one. In the case of revenue, where we are, right? In the case of revenue, which is received in advance, what does it say? The tax base of the resulting liability is its carrying amount. Which carrying amount are they talking about? Is its carrying amount 753,464 right? Less any amount of revenue that will not be taxable in future periods. So what they're trying to say to you is that you guys at third levels, you have done tax 2601, you have some of you are currently doing tax 3761. So we have taught you that if a company receives income in advance, according to the gross income definition, SARS will tax it immediately. Right. SARS does not say just because Jeffrey, you have received money from a contract, you have it in your bank account, we are going to tax it when you start working. Then when you record, no. SARS says you've got it, we tax it in this year. So that we don't tax it anymore in the future. When you're now recognizing it for accounting purposes. All right. So when you're now preparing your tax returns for the company, and you're now recognizing those liabilities as revenues now for in your accounting books, right? SARS won't tax that income because they have taxed it already. That's why they're saying to you, less any amount of revenue that will not be taxable in the future. So this amount won't be taxable in the future anymore. So for calculating a tax base of a liability, how do I know it's a liability? Because you record it in the books of accounting under liabilities. That's why it's called liability. So the tax base of a liability will be its carrying amount less any amount not taxable in the future, the same amount. So that man, that how much you get?
Zero.
Exactly. Did you get what I say? It's a link between this and taxation. You need to be fresh. Deferred tax goes hand in hand with tax. So you can't be an enemy of tax and do deferred tax. You never get it. All right. So that's for the value on this 10 page. Here, what you're supposed to write here, right? I hope I did some justice to someone. So here is nil. That's why I cast comment. So for cramming purposes, any income received in advance under the tax base just come and say 0.
Okay.
If you think you didn't get what I said. Right. Then here it will be in brackets. Then this multiplied by that, you get that figure of 202, blah, blah, blah. That's how I arrive at this amount. I'm just showing you how I got to it. Time. Right. So that's how I got to this figure. That's why I was generalizing. So can you see it's a deferred tax asset? That's why it's on the debit side. And then the income tax will decrease. That's why it's on the what? Credit side. Because income tax is an expense. So if it's on the credit side, you are decreasing your income tax. So if they ask you to generalize, this is how you generalize that. If they want to be funny. All right. Then there's the other one. Whew. One more. Okay. So let's do this. I think let's end with revenue. Then we continue with leases on Sunday. Right. On 1 Jan 2020. Oh, sorry. On 1 September 2022, Veranda entered a BEE deal with Khoto, trading within Veranda Limited, wherein Veranda Limited would sell beetroot to the value of 6 million to Khoto Trading. The contract stipulates that Veranda will make a non-refundable payment, not deposit, payment of that much to Khoto Trading at inception of the contract. The upfront payment will assist Khoto Trading in setting up its supply chain and distribution networks. On 31 December 2022, Veranda Limited had sold beetroot to the value of 2,800,000 to also trading. Right, so you see what's happening here. They call this consideration payable to a customer. All right. So what is happening here? This happens a lot, okay, in businesses, right? I go and get a tender, right? Mine, right? They say, Jeffrey, can you please help us with what? Transport. Okay, help us with what? With transport. Okay, so what do? Okay, so I'll provide them with transport, but it's just Jeffrey. Jeffrey's just there. All right, doesn't have the what? The money for the car. So what do? These guys will what? Advance. They'll what? Advance me money. You understand? Hello?
Yes.
Yes, they will advance me money so that I can buy the quantums, the 10 quantums that I need. That is what is happening here. So they're just telling you to say, okay, now in such a situation, how will the mine recognize revenue? Okay, so okay, so we are saying that the contract was here 6 million to Khotso trading. So these guys want to sell 6 million worth of vegetables to this one, but this one doesn't have the money. So they give him money, a non-refundable payment, so that he can what? Set up business networks. I hope this mining example makes sense. All right. So in other words, I will not return this money to these guys. No. But these guys will get this money, right? As I what? As I transport their clients. That's how they'll be getting back their money. Right? Getting back their what? Their money that they gave me in advance. You understand? That is what's happening there. Does it make sense?
Yeah.
All right. So that means now, how do they recognize their money? Okay. So it's going to be measured. It's going to be based on the progress.
That's one.
On the progress made so far. That's how they'll be recognizing their money, based on the progress that they have made so far, that I've made towards them. That's how they recognize their money. Okay. So let's calculate. So remember, this Uveranda is expecting what? 6 million. That's the transaction price. Right. Then upon this transaction price, so it's actually called progress, right? Progress payments, right? So as we progress, we are recognizing. Okay. So remember, so far they are saying as at 31 December 2022, right? We've delivered, right? Beetroot, cabbage, what, up to what? Up to 2.8. So we use that. We are saying then, what is the equivalence of this 2.8 on the transaction price? So we'll come and say, okay, 2.8 over 6 million multiplied by 100%. How much do you get?
%47.
So that means so far we've managed to what? To render services equal to 47% of the 100% that we are expecting to render towards this custom. All right. And then now we are saying, how much does this guy owe us? How much does what's his name? Khoto owe us? How much?
50.
Huh? That's the price. Eh? So now how much can you recognize based on what we borrowed him? So we'll come and say, okay, 47% multiplied by how much we get?
$583,000. Triple three.
Right. So this is the revenue that we can recognize based on our progress. Right? This is the amount of money that we can what? Recognize. All right.
Chef, I got 587,500.
Also, I
Right. So that's what we're getting.
Yes, sir.
yes.
Yes.
Okay. So that is the value, right, that we can recognize. Okay, that is the value that we can recognize from what we are owed by this person. Okay, because remember, it's a non-refundable payment. So we are saying as we perform, right, the promise towards, we are redeeming some of our money that we advance to this guy because he's a customer. Okay. So as we deliver, we are recognizing that portion, right? So the main focus is on that portion. So that means that is that. So what about how much is left to recognize? 3% times that.
It's 662,500.
All right. So this is what they call a contract receivable. Right. This is what they call a contract receivable. It's like a debtor. Right. So it becomes a what? An asset. All right. All right. So that is what you get. Any questions? Right. So this is an asset. Okay. So same thing, same application when it comes to the deferred tax. Right, remember, this becomes a contract. Contracts, receivables. So contract receivables, the amount that is left to receive from this guy is 66,500. Okay, remember this is an asset, so carrying amount, tax base, temporary differences, deferred tax. All right, so it tax base, right, will be nil. Okay, because why? Remember, when you gave this person the money in what? In advance, right? You gave him in advance. In your books, right, as the person giving, SARS deducted that amount in full as an allowable deduction. You understand? So that means there won't be any tax base here. There won't be any what? Any tax base. Because the way that SARS dealt with this, the full 1.5, he allowed you to deduct it in your tax returns in full for tax purposes. But in accounting, we what? We recognize it in portions based on what we've managed to redeem so far or to what? Get back. So hence there's a temporary difference. So that and that will give you that amount. And that amount multiplied by the rate, how much you get? Right, you get that. That amount is in brackets. Why? What is the song? Carrying amount of an asset. If the carrying amount of an asset is greater than the tax base, what do you have?
Liability.
A liability.
Liability.
That is the song. If the carrying amount of an asset is greater than the tax base, you got a base called liability. So you come here and say contract receivables. Right? You come and write that figure in bracket. Then you add and that, you know, net off, I think you come and say deferred tax. They want this end result. Deferred tax assets. That is the net amount. That and that. You come and write amount without brackets. Okay. Right. I think we can stop there. Information overload.